Tech giant Infosys trades mildly lower after delivering an earnings beat and raising revenue guidance. HCL Tech sees cuts of over 2% despite a beat on revenue and margin. Analysts say implied fourth quarter guidance for the sector looks muted and there is no visibility on client budgets for FY24.
Anand rally is after delivering a strong third quarter. The dollar revenue grows around 12%. Profitability grows over 95%. The management tells CNBC-TV18 they expect a meaningful acceleration in demand going ahead.
L&T Tech Services announces the acquisition of L&T's Smart World and Communication business for 800 crore rupees. The stock is lower by almost 6%.
Jefferies issues an underperformed rating to Gujarat Gas, cuts the target price to 400 from around 570 a share earlier, expecting a structural drag in pricing power, margin as well as volume growth.
ITI surges on a 25 crore rupee order for laptops while RVNL continues its up move after a near 40 crore order coming in from the Southern Railways.
Hello and welcome to Chartbusters. It's a Friday morning. It's Friday the 13th. The hope is that we don't have such a bad day. For the time being, though, the first hour of trade goes to the bears. We're holding at around that 17,800 odd mark. But we took you through the headlines and we briefly mentioned Gujarat Gas. Well, Manglam, that stock is down 3.5% odd. Jefferies, they have downgraded the stock.
They have downgraded the stock, and for good reason is what they believe. They believe that, the outlook on spot LNG prices is rather firm, and that's why they've downgraded the stock to underperform. They've also cut the target from 570 rupees to around 400 rupees. Why is that? Because they see a structural drag on the company's pricing power, margin outlook, as well as volume growth in the medium term. They've changed their estimates. In fact, volume estimates, they've, scaled to 17 and 15% for the next few years. And they've lowered their EBITDA target as well for the company by about 15% because of lower volumes as well as compression in margins itself. As a result of which, the EPS growth for the company, the profitability, will compound only at 5% is what their assumption is between FY22 and FY25. So for a company whose EPS expands by just about 5%, does not fit in their, scheme of metrics, which is why they've cut the target price from 570 all the way down to 400. That stock lower in today's trading session.
Okay, all right. Manglam, thanks for that. Well, by the way, just keep an eye out on the index. A few stocks, they're making a bit of a bump up in an otherwise wobbly market. Sun TV has moved to the high point of the day, so that should come up for you on the screen. NMDC, you have seen a big surge in iron ore prices, global iron ore prices. That gives NMDC case to go ahead and hike prices going ahead as well. And if that's the case, the stock is doing well. It's up close to around 2% as we speak. And another one is SAIL. That as well has moved to the high point of the day. So pretty good news there. On the flip side, you have Granules that's moved lower. Berger Paints is seeing some selling as well, Manglam.
Yes, Nigel, I'm looking at Bata. It's uncharacteristic, the kind of decline that we're seeing on Bata. Currently at the low point of trade, down almost 4%. We usually don't see, moves so big on a counter like Bata without any reason. Just trying to find out if there is a brokerage note or something of, the company has made any announcement or something. But down 4% for Bata and on high volumes as well. So this is another stock that we will keep on our radar.
Okay, all right. Well, let's move on then and let's address Anand Rathi Wealth. Well, they saw a steady growth in the third quarter, seeing growth in assets under management, although the client addition was a little bit slower than what we saw in the previous quarter. But to understand these numbers in a better manner, we're joined by Feroz Aziz, the Deputy CEO of Anand Rathi Wealth, who's now joining us. Hi, Feroz. Always good speaking to you. Wishing you and the team first a very, very good year ahead. That's 2023. Well, let's talk about business. I have your revenue breakup, MLD revenues, but I would like to know what is the MLD issuances for the past quarter, because you'll be getting a percentage on that. So for the past quarter, what was that? And if we could split it up between primary and secondary as well. Go ahead.
Yes, Nigel. Good morning and Happy New Year to you as well. It's always a pleasure talking to you. When it comes to MLD business, we are looking at a total primary issuance or distribution of 1,151 crores and secondary is about 277. The primary business is a very consistent business because a lot of maturities come. We've been doing the MLD business from November 2012, which is 10-year plus running. So there are maturities of the previous series which come. So you have a consistent 350 kind of crores plus or minus 20-25 crores every month. And that's where you have 1,151 and 277 for the answer for the pointed question you asked, Nigel.
Right. And, your net client addition, as we were pointing out earlier as well, that's decreased a tad from what, close to around 395 in the first quarter to 451 in the second quarter. Now it's come down to 274. Is there a concern for worry? Was there anything specific in this quarter? Going forward, what is the expected run rate?
Yes. So Manglam, when you look at client addition, we generally have a very clear practice of counting clients on the market value basis. When markets go up and down, there are some which go below the threshold. Is why quarter on quarter seeing this number will be a little volatile, because we don't count all clients. We count a client beyond a certain threshold, which is 50 lakhs of assets which are there. And if the market falls beyond a certain point, he or she slips out of our client list, because you don't count a 10 lakh rupee client. Because you're in the business of wealth management for HNIs. That's point one. Point two, if you look at this number of client acquisition on a 9-month basis, which smoothens this volatility because of market movement and portfolio redemption, somebody takes away 5 lakhs and then he is no more a client from the accounting practice perspective. So if you look at the same period, 9 months, 810 for the previous year, and 1,100 odd, 1,120 odd for this same period, 9 months.
So this 20-25% sort of growth that you've seen over 9 months is a more sustainable number to look at from a year-on-year perspective for the foreseeable future. Is that correct? Is that the way to look at it? Or will that growth itself come down to 15 to 20 as the base increases?
No, I think growing the client base at 20-25% isn't going to be a challenge, because we are looking at almost about 7-8 lakh HNIs, and we're speaking about 8,000 of them. Getting the next 8,000 is that much more likelier, because this business is a vintage business. If clients have a larger experience and a pleasant one, they refer more clients. So it's a cascading, a nuclear reaction kind of an business. So I don't see any challenge of growing client set for long periods of time at the rates indicated.
All right, Feroz, you said the primary issuances were 277 and the primary was 1150 or 1051?
1151.
1151. All right, we'll just correct that on the screen then. Feroz, I sometimes speak to some of your employees and they seem quite happy. Now the revenues have gone up on a sequential basis, though the employee cost as a percentage has come down a little bit. What's gone on there? Could you explain that to us?
Yes, Nigel. Nigel, since we are running a business which is a wealth management business, which people are compensated on a total comp model, which was developed way back in 2007 June and not modified at all. That's one of the reasons why we have zero regret attrition. Any RM greater than 40 crores, we call them as regret attrition. We have had zero regret attrition in an industry which is normally sees 15-20% attrition, especially in the RM fraternity, because those are the most sought after. So coming back to your point, they are happy. Because it's a total comp. So bonus provisions have gone up to 55 crores for the first 9 months, which if I remember right, for the first 9 months last year was about 46 crores. So that's the reason why fixed comp is not the only variable. It's a total comp, and that gets paid out at the end, and you see larger bonus provisions, which are, if the business does well, and the bonus provision goes up, and people in effect make total comp which is greater than the last year.
Right. Your guidance, the AUM guidance has been raised to 40,000 crores. That still means a 3.5% growth sequentially. Just wanted to understand, because the last couple of quarters you've grown between 7 to 9 odd percent. So is there a bit of a slowdown, and what is the sustainable growth rate out here?
See, our AUM growth rate is going to be 20 to 25% for year on year.
Okay.
Quarter on quarter, because these AUMs have mark-to-market impact. Firstly, our DNA says we have to be conservative. And if the AUM number is a specific 31st March number, we would want to be ultra conservative, because there are some external factors. If the Nifty is down, then the AUM would read down. Because it has the market impact plus the effort put in by all my colleagues and me, I would rather have a conservative number there. And AUM growth of 20-25% has happened for the last 10 years. It should happen for the next 10 years, because God is kind to a business like ours, because with passage of time, markets move up and clients make 10-12% on their portfolio. We just have to work for the residual 12-15%.
Feroz, give us a broader sense, for your company as well as from the market perspective, how is the customer behavior changing? I'm looking at your mix currently, it's skewed towards equities rather than debt, but the interest rate scenario is rising. So are you seeing a bit of a shift out here? Do you expect that to happen? And are you experiencing any kind of redemptions?
No, Nigel. See what the 8,200 clients which we are speaking about, whom we deal with, are a homogeneous group of HNIs who have intergenerational wealth. We don't believe in managing corporates, treasuries, who might have a sudden capital expansion. They would take away the money. So these are intergenerational wealths. All the allocations are derived out of their return risk objectives, which are numerically defined. If a person has a 13% return objective, my team finds out what is the least standard deviation at which 13 can be achieved. And if there is a specific allocation on that basis, that's the allocation which most people stick to. So we run only 4 portfolios for 8,200. So my 81 member research team focuses only on 4 portfolios so that they can deliver the best. You can't have 8,000 customized portfolios. So coming back to your pointed question, are we seeing flight of capital from equity to debt? The answer is no, because this is intergenerational wealth. But we are seeing we are catalyzing a large infusion, which should fructify in the next 1 year from FDs to target maturity funds. Because if you can lend to a government of India and still make a 10% implied pre-tax FD for an HNI who's on the highest tax bracket, there we have seen some traction. We've been able to redeem 500 crores of FDs and moved it to target maturity funds, and that will, I think, catapult into a large net mobilization activity over the next 1 year.
All right, and final question then from my end, Feroz, can you please help with the revenue and profit split of equities and MLDs for you?
See, our trail revenues have gone up about 27%. We target a 50-50. I think we are somewhere around 42% coming from trail revenues of mutual funds and some other incomes of 2-3% from brokerages and other PMSs, which are there residual in the other assets of 12%. So we are targeting to have 50-50. I think we are moving in that direction.
And profitability split?
The profitability split can't be done product-wise because the product profitability is on the revenue side. So I think I would not be able to split profitability on products. Both the yields are similar. Let me try and answer it this way. The yield which we make post GST on mutual funds, the 11 scheme model portfolio, is 1.11% post GST, and we make 1.17 for the last 10 years. We've made 1.17% on MLD. So the yields for both the products are same.
Similar.
The recognition of accounting could be different.
Good speaking to you as always, Feroz. Thanks so much for stopping by. Wishing you all the best for the coming year as well, and look forward to catching up with you. Well, for the time being, though, keep an eye out on the markets. We've seen a good recovery yet again. So it seems the market's going to around that 17,770 and bouncing back up 50-60 points odd. The question is, can it hold on to these levels? And I'll tell you what, there appears there is some shorting at higher levels. If, in fact, we don't break that 17,770, we could see a big bounce from here on. That's only if we can hold above these levels. So let's see whether that does play out today as well. For the time being, we'll slip into a short break. When you come back, we'll have Manoj Jaiswal, who will be joining in for a technical check on the markets.
Welcome back. Once again, we're looking at seeing some sort of recovery, but recoveries are being sold into just the way supports are being bought into. It's an interesting phase for the market right now. It's been consolidating for the last few trading sessions. Let's see where we go right now. But current recovery or a sliver of that recovery can be attributed to a couple of these stocks which are doing well. Of course, the metals pack has been doing well since morning, has only extended its gains. So the metals index actually at the high point of trade. Leading that is JSW Steel as well as Tata Steel. And Reliance has recovered a fair bit from the low, so just keep an eye out on that one. And we also have seen some recovery come by for Infosys. In fact, in just the last few minutes, Infosys has recovered about 0.75% from the lows, still in the red. So let's see where it goes. Let's get in a quick market technical check. We have Manoj Jaiswal joining in. Manoj, it's been consolidating for a while now. Where do we go from here? Because the choppiness is what's, I think, confusing and at times perhaps even frustrating the day traders.
Good morning, Mangalam. So this is a phase of consolidation, I believe, and I think now one should keep eye on 17,750 first, because if Nifty breaks 17,750, then definitely you can see almost 200 to 250 points downside in Nifty. However, we all know that the trend is still negative, because Nifty is facing resistance on high levels in the range of 17,950 to 18,000. So if you want to go long in this market, then I think you should wait for a breakout above 18,000. So I think in between 17,750 and 18,000, I think you should play stock specific. So on the one hand, metal is definitely looking very strong on the chart. So I would like to go with the Tata Steel because stock has given a fresh breakout today. So take a long position here. Stop loss should be around 118.50, and here the target would be around 125. And on the other hand, IT stocks are looking weak. So I would like to go short in LTIM, that is LTI Mindtree, because stock has given a fresh breakdown on the charts. So here one can create short position for the target of around 39.50. Take a short call here. Stop loss should be around 42.60.
Okay, all right. Thanks a lot, Manas, for joining in and giving us your take on the index as well as a couple of trading strategies. Well, time to take a short break, but as we do that, here's an important information for our viewers. Don't miss out on the 19 must-have stocks for 2023. Subscribe to Money Control Pro to get the full list. Welcome back. Well, let's focus on HCL Tech. That's the top loser on the Nifty, despite an earnings beat in the third quarter. The sector as a whole is falling today as analysts say that the guidance remains muted and visibility on growth in FY24, well, it remains a little bit hazy. Earlier today, we caught up with the management of HCL Tech to understand what growth could look like for the company going ahead. Let's hear out what they had to tell us.
Furloughs was a little higher in the last quarter. In spite of that, we delivered very good numbers. A little bit of that will spill over, especially Asia Pac financial services. We see a little bit more furloughs in the JFM quarter. But that's all baked in. I think we've given a whatever total guidance of 16 to 16.5 in the services business. All of that is baked in. There is a 70 basis points improvement in the operating parameters. So it's been an exceptional quarter of execution where we delivered efficiency in the operating model, whether it is freshers, automation, and better utilization, all of that. So I think that's really talking about the key levers that we have for improving margins, whether it is freshers, whether it is improving utilization, improving realization. All those metrics are a very, very sharp focus for us. And that was the logic of providing a roadmap of getting to 19 to 20% margin profile. From next financial year, we see a strong uptick in the retail CPG segment. And that's also enabled by the new bookings, which is a couple of deals that we announced. We announced ODP, we announced Mattel, both are in the retail CPG segment. Both of them will give us good headwinds, good tailwinds in the Q1 of next year.
There is no deal cancellation for sure. Even I don't think we said that there is a slowdown in deal making. We said, deal wins continue to be decent, and that's what we announced yesterday. $2.35 billion is a very good number for us. And you're absolutely right. We have been in that narrow band of $2.5 billion every quarter on the trot for at least the last 5-6 quarters. So I would not say deals have slowed down. Yes, there are some. I mean, Europe is one geography we talked about, but at an overall level, we are not seeing a slowdown.
All right, and in an otherwise weak day for IT stocks, Cyient is the one stock which is surging after reporting its numbers for the third quarter. Strong performance. The dollar revenue surged nearly 13%. Margins too have expanded to about 13.2% from about 10%. In another key positive, the deal pipeline for the company looks strong with 5 new deals in the services segment. The management joined us earlier today to tell us more about the quarter gone by and the outlook going ahead. Let's listen into what they had to say too.
Of course, there are certain industries like semiconductor which are slowing down a little bit, and we just will mitigate against that. But some of our large industries are doing quite well. Therefore, from a demand perspective, at least that 3.5% number that we see, at least that demand, we will see acceleration of that. We'll actually see meaningful acceleration of that. So we're quite confident that within the next year, we'll at least get to the mid-cap average.
Okay, all right. Well, we've completely run out of time on this edition of Chartbusters, but you stay tuned. Trading Hour comes up next.